very much, and I hope this is informative for you. Informative and terrifying. And next, we're going to bring up our token male. Dan Schwartzer, who's the Deputy Commissioner of Insurance at the Office of the Commissioner of Insurance. Governor Scott Walker appointed Dan as Deputy Commissioner of Insurance for the state of Wisconsin on January 4th, 2011. The Office of the Commissioner of Insurance regulates the business of insurance in Wisconsin. The office has a staff of 153 and is responsible for examining industry financial practices and market conduct, licensing agents, reviewing policy forms for compliance with state legislation, investigating consumer complaints, and providing consumer information. In addition to its regulatory duties, the agency administers the State Life Insurance Fund, Local Government Property Insurance Fund, and the Injured Patient and Family Compensation Fund. Prior to appointment, Mr. Schwartzer owned his own association management and government relations firm that worked with trade associations from a variety of industries. He served as executive director for the Wisconsin Employee Benefit Advisors Association, representing insurance agents throughout Wisconsin, and executive director for the Wisconsin PPO Association, which represents PPO health plans. Mr. Schwartzer was also executive director for the Wisconsin Economic Development Association, as well as executive director for the Independent Business Association of Wisconsin. Mr. Schwartzer is a Wisconsin licensed intermediary holding property, casualty, life, accident, and health insurance licenses. He has over 25 years of experience in insurance, healthcare financing, and business issues, and over 12 years experience in association management. I think Dan is going to talk about what the state is doing as far as exchanges, perhaps elaborate on that, and I know we all look forward to them, so Dan.
Can you hear me? Okay, great. Well, thank you very much. Appreciate the opportunity to come and chat. I do not have slides. I certainly wouldn't want anything I have to say put in writing. It'd be helpful this would be a very easy discussion. In all sincerity, we made a decision quite a while ago as we were continuing to be asked to speak on healthcare reform as to whether or not we would provide any PowerPoints. And we would imagine us changing the slides every 5, 10 days, and it just wasn't working. So I still am amazed to be asked to come and speak to audiences about what we're doing as a state, because we don't know what we're doing as a state as it relates to the regulation, because we don't have the guidance yet from HHS and society that still remains. And so it's difficult, but what I'm going to try to do is talk a little bit about why we made the decision that we made not to do exchanges, talk a little bit about that, and then also talk about what we are doing as an agency to try to come up with the answers that we need to come up with in order to regulate our market. As Michelle said, we have a staff of about 140 people, and we regulate the insurance industry. We have 2 primary responsibilities in the department. One is consumer protection, and one is insurer solvency. And we focus on that in any aspect of regulation that we do, including health insurance. We regulate over 380 domiciled insurance companies, over 2,000 licensed domiciled and non-domiciled insurance companies, and over 115,000 insurance agents. And so it's quite a big task for 140 people, but we think we're a fairly lean operation. A while ago, you probably saw that the governor, the administration decided not to go forward with a state-based exchange. And I wanted to talk a little bit about the decision we made, why we made that decision, and to be clear, I want to assure you that the decision made not to do a state-based exchange was not a political decision. I know that there's been some conversation and some press about that it was politically motivated, but it had nothing to do with politics. It had everything to do with logistics. And it was not done in a vacuum. We spent a year or more doing research and development on the law, on PPAC as we call it, to determine what its effect would be in the state, what it would do to our marketplace. And I want to talk a little bit about that research and development, and that kind of rolls into why we made the decision that we did. At that time, the only study that was available in terms of what impact it would have on the state, both in premium and market disruption, was from two entities, one, Gorman Actuarial and Dr. Jonathan Gruber. Prior to us getting in the office, there was a study that was commissioned by the previous governor to determine the effect of PPACA on the state, and they used Gorman Actuarial and Dr. Jonathan Gruber. And when we got into office, we had the ability to change that and hire a different actuarial firm, but we decided to stay with Gorman and Gruber because both of those individuals were involved with the president as they were developing PPACA and trying to score it to the CBO. And we felt that whatever they came up with, we believed that would, number one, be the floor, but that no one could argue with that floor because they were very much proponents of the legislation. And after months and months of research, Gorman and Gruber came up with their estimate of what would happen in the marketplace. And at that time, it was believed that individual insurance premiums in the individual market would go up about an average of 30% for the majority of individual consumers. That was after you applied the tax credits. So if you look at the actuarial analysis that was referenced by Marine, or I think it was it's probably close then, because that's after you apply the tax credits. There would be about an average increase in the small year market of about 15%. About 150,000 people would be moved off of their, and not from a voluntary basis, but would be moved off of their small group plan or their group plan and be put into the individual market. There would be a new, about 10,000 newly uninsured people that were formerly insured would become uninsured, about 10,000 people. So we had some real concerns about the cost impact that it would have on the state. We had some concerns about MLR. I think that was discussed as well, about medical loss ratio, that insurers would now be held to a standard that they couldn't spend more than 20% on admin costs. And while that certainly seems like it's a good idea and prevents gouging in the marketplace by insurers, we have and we continue to have concerns about MLR because it doesn't necessarily get to the solvency issue of insurance companies. That is one of the main things that our department does, is make sure that insurers are able to honor the commitments that they make and pay the claims in future years. And when an insurer goes out and tries to set their insurance rates, they do it about 18 months in advance, and they try to make a best guess as to what they're going to spend on healthcare costs. If their actuaries at the insurance company are right on, they'll be able to figure out exactly how much they're going to spend in claims and how much they want for profit, and how much it's going to cost for administration. But oftentimes, those insurance companies and the actuaries aren't right in terms of what they're going to predict for insurance claims. And if they are wrong and they get clobbered in a year, insurance companies, and much to our approval, increase rates a little bit higher the following year to make up for the loss that they incurred in the year previous. What MLR does is prevents an insurer from recovering when those actuaries were wrong in previous years. Where we have a concern as a department is if they are wrong in a previous year and they get clobbered and they have no way to make up that loss in future years, will they remain solvent, or do we need to come in and shut them down because they don't have enough money to honor their commitments going forward? So it's kind of a catch-22 for our agency. We're here to protect consumers, and part of that consumer protection is to make sure those insurers are solvent. So MLR is just one example of that. And we also had a lot of concern and continue to have concerns as it relates to the navigators. Insurance agents are licensed and regulated by our office, and we tend to like our regulatory scheme as it relates to the regulation of insurance agents. We have the ability to require them to have errors and omission insurance, and we also have the ability that if an agent makes a bad advice to a consumer or does something wrong to a consumer, not only do we have their E&O policy to go after to make the consumer whole, but we can also reach through that agent up to the insurance company and grab whatever we need from the insurance company to make that consumer whole. We think that's a pretty solid regulatory scheme as it relates to consumer protection. Our concern on navigators is that they don't have to necessarily be licensed. There are some regs that we might be able to implement, but are we going to be able to force a navigator to have some type of liability coverage so that if they make bad decisions, we can go after them and make them consumer goal. So those are some of the things that we were concerned with as it relates to the impact that this was going to have on the state of Wisconsin. We also had a lot of concern as it related to whether we were going to do a state-based exchange or not as to the long-term risk to Wisconsin taxpayers, whether it's in the form of tax increases or whether it's in the form of higher insurance premiums. We're concerned about the cost structure of setting up an exchange. Massachusetts is a good example. Utah is a good example in terms of what kind of cost structure, infrastructure is needed. And you were literally talking about $50 and $100 million cost structures. Now, there was some ability to get federal funding in order to pay for that cost structure, but in our opinion, federal tax dollars are a little different. State tax dollars will still come from the taxpayers. So we had some pretty grave concerns about what it would mean to Wisconsin taxpayers if we move forward on a go-forward basis. There was a tremendous amount of discussion back and forth between our department and HHS about what they call the flexibility that they were going to allow states in terms of setting up exchanges that might be unique to their state and recognize some of the variances from one state to the next. And we were encouraged at the beginning, but then as we moved forward with HHS and further discussions, that flexibility just wasn't there. Whether you were talking about eligibility or minimum standard of coverage or essential health benefits, essential health benefits is probably the best example. We were told that we could set up essential health benefits as it related to the state of Wisconsin, whatever was best for the state of Wisconsin. And then further guidance came out and said, you can do that, but we're going to limit you to 3 options. And the 3 options would be the top 3 writers in your state, the combination of the top 3 writers in your state, or the top writer in your state, or the federal plan, or the most popular plan in your Medicaid program. And then when we started to move towards, let's look at the top 3 writers and try to pick what's best from each one of those particular writers, HHS came back and said, well, it's not necessarily you can pick and choose. You have to look at the top 3 writers and pick the exact plan that they have, but you can't Frankenstein the thing together. So there really wasn't a lot of flexibility provided. The last 2 years, I think, showed that, and again, had us concerned as to whether or not we would have flexibility. We were given 3 options in terms of an exchange: a federal facilitated exchange, a partnership exchange, or a state-based exchange. And looking at all of the concerns that we had, and particularly looking at the fact that we really didn't think PPACA understood Wisconsin's marketplace and how Wisconsin operates. I think Maureen mentioned it a little bit. I'll talk to that as well. We are a very unique state. In fact, we are the only state that has as many competing carriers as we have. The whole focus of a state-based exchange was to try to create competition. That it was going to have this virtual marketplace where insurance companies would compete fiercely with each other, because in many states there is only one dominant player. They own 75% of the market share. But in Wisconsin, we have 33 small group carriers. We have 25 individual carriers that compete in the individual market, and you need to get past 10 carriers in both of those markets before you end up with 80% market share. We didn't need an exchange to make us competitive. And so for all of those reasons, we decided to not do a state-based exchange. The feds will come in and do a federally facilitated exchange. Our goal remains consumer protection and insurer solvency. And so now we are tasked with figuring out how we can provide those 2 services that we're supposed to provide: consumer protection, insurer solvency, on carriers operating in the federal facilitated exchange. It's a process that's going to take quite a bit. There are 20 to 25 other states that are in our same boat, and so much of our work now is being spent at the national level with the National Association of Insurance Commissioners in those 20 states. Wisconsin is chairing a few different work groups. The Alternatives Working Group, which is looking at those states that aren't doing a state-based exchange. Where does the regulation start and stop from the feds, and where does the regulation start and stop from the state? Where is the state preempted? We have a legal authority subgroup that we're also chairing. And so over the next several months, we will work with the 20 to 25 other states that are in the same boat that we are in, determining how we can preserve our market outside of the federal facilitated exchange. It's not our desire nor is our duty to make the federal facilitated exchange successful or unsuccessful. It's our duty to make sure that consumers are protected and that insurers are solvent inside the exchange or outside the exchange. And we have learned over the years that the best consumer protection that we can provide as a department is choice and competition. And so we have spent the last 2 decades, 3 decades, long before Ted Nickel and I have ever gotten to the department, in making sure that there was choice and competition, that we fostered a very competitive environment. That will remain our goal going forward, is to make sure that we don't lose carriers along the way, that carriers aren't forced out of the business, that our market somehow preserves that and preserves the consumers, the consumers, that choice and competition. And so I apologize that I don't have more answers for you, but it will be quite a long process, and I know that the volume that the carriers are in, because we don't anticipate completing our work at the national level at least till about April, in terms of where we're preempted and where we're not, and what we're going to do as a state in terms of how we're going to regulate those carriers in the exchange and outside the exchange, how we're going to regulate navigators. But we are doing it as absolutely quick as possible. We have moved every resource that we have in the department to figure out these questions and get answers to those questions. And again, we'll continue to make our #1 goal choice and competition so that we can carry out our functions of consumer protection and ensure solvency. So